Well, because bond pricing is giving people problem, let's take a look at a discount bond. BZ Corporation issues 5% 10-year bonds with a total face value of $1 million. The market rate for bonds of similar risk and maturity is 5.1%. Interest is paid semi-annually. First thing you want to note here are the characteristics of this bond. The stated rate is 5%. The term is 10 years. The face value is $1 million. The next thing you want to note is that the stated rate is less than the market rate. The stated rate is 5%. That's the rate that we're going to use to determine the interest payments that we pay our investors over the next 10 years. Is less than the market rate of 5.1%. Since the stated rate is less than the market rate, we will receive less than the face value for the bond. In other words, the price or the value of the bond is not $1 million. It's something less, and the reason it's less is because the stated rate is less than the market rate, and investors expect a return that's at least equal to the market rate. First thing we want to do is calculate the value of the bond, or the price of the bond. Remember, bonds have two cash flows, a principal or a face value, and in this case that's $1 million. That's a single sum or lump sum. And then the cash interest payments. The cash interest payments are determined by taking the stated rate and multiplying by the face value. Because this is a semi-annual problem, we take the 5%, divide by 2, and get 2.5%, and that will be the interest that we will pay every 6 months. 2.5% times $1 million is $25,000. That $25,000 will be paid over the next 10 years, or 20 cash flow periods. That's referred to as an annuity. So in our calculator, we will put 20 for our N because it's a 10-year term times 2 payments per year, 20 cash flows. In our IY, we will always put the market rate of interest. Well, the market rate is 5.1%, but it's a semi-annual bond, so we divide by 2. We use 2.55. The payment will enter $25,000 because that was determined by taking the stated rate times the face value. And the future value is $1 million. When we compute our present value, we get $992,242. Now let's do this same problem using the tables. The tables we use for bond calculations are always present value tables. We're trying to determine the value of cash flows today, so they're present value tables. The lump sum or single sum amount always uses the present value of $1. The rate we want to look up is 2.55% and the term 20N. Well, the tables don't have a 2.55%, so we're going to use the upper left-hand calculator for the table. We're going to enter 2.55%, and then we're going to enter 20N. And we get a present value of $1 factor of 0.60435. We're going to go down to the present value of the annuity table and do the same thing. We're going to enter 2.55% and 20N. The present value factor for an annuity is 15.51579. To calculate the price of the bond, we're going to take the lump sum or future value amount of $1 million, multiply it by the present value of $1 of 0.60435, and we're going to get $604,350 for the present value of the face value. To get the present value of the $25,000 cash interest payment, we're going to take $25,000 and multiply it by the present value factor for an annuity of 15.51579, and we're going to get $387,895. We're going to add the $604,350 to the $387,895, and we're going to get a total price value of $992,245. So we have a $3 difference between the calculator and the table. The reason for that difference is because calculators do not truncate any information, where tables truncate everything. The difference between the face value and the price of the bond is $7,755. That difference is referred to as a discount. In other words, investors gave us less for our bond than the face value. They gave us $7,755 less. Upon maturity, we're going to give the investors $1 million back, not $992,245. By giving them more back at maturity, we're allowing them to earn their market rate of interest of 5.1%. The second part of this problem says when the company records the first interest payment, how much will the company record for interest expense? Round to the nearest dollar. Well, interest expense is always equal to the bond carrying value, which is also referred to as the bond liability, times the market interest rate. So for our calculator, we're going to use $992,242. That's our bond price and our beginning bond carrying value. We're going to multiply it by the market interest rate of 2.55% or 0.0255. We get $25,302.17. The problem says to round up to the nearest dollar, so we'll say $25,302. For the table, we're going to take the $992,245, multiply that by the market rate of 0.0255, and get $25,302.24. Rounded to the nearest dollar, it too is $25,302. The next part of the problem asks for what is the bond liability or carrying value after the first interest payment. Round to the nearest dollar. Well, the carrying value is always the carrying value from the prior period plus the amount of the discount amortized during the current period. The amount of the discount amortized is always the difference between the interest expense recorded and the cash interest payments made to bond investors. So in this problem, the interest expense recorded was $25,302. The cash interest payment made to bond investors was $25,000. The difference between the two is $302. So the new carrying value, based on the calculator, would be $992,242 plus $302, or $992,544. The new carrying value calculated using the table would be $992,245 plus $302, or $992,547. Our carrying value goes up each period for a discount bond because at maturity, the bond has to reach $1 million. So every time we calculate a new carrying value, we will add that amortization amount to the prior period's carrying value. When the company records the second interest payment, the interest expense will be, again, based on the beginning carrying value from the prior period, $992,544 for the calculator, $992,547 for the table. We multiply it by the market rate of interest of 0.0255. We get $25,309.88 using a calculator, $25,309.95 using the table. We round those numbers up to $25,310. The fifth part says, what's the bond liability or carrying value after the second interest payment? Round to the nearest dollar. The carrying value is always going to be the beginning carrying value plus the amortization amount for the period. The amortization amount for the period is the difference between the cash payment and the interest expense. For the calculator and the table, the cash payment was $25,000. The interest expense was $25,310. So we're going to amortize $310 of the discount. Remember, when we're calculating bond liability or new carrying values, we add the amortization amount for discount bonds. So for the calculations, we will take $992,544 and add $310 to get $992,854. For the table, we will use $992,547, add $310, and get $992,857. The last question asks, what's the bond liability at the end of 10 years? And again, it's $1 million because all bonds have to mature at face value. So that's it for bond calculations. It's important that you can calculate the issue price of a bond, the interest expense for the bond, and then the carrying value of the bond. Those three calculations are extremely important for you. Hope this video helped. Thank you for watching it. Good luck.